In the spring of 1864, in a counting house on the Hong Kong waterfront, a group of merchants and traders gathered to discuss a problem that the British Empire had created for itself and could not easily solve. The problem was money, not the absence of it. There was in Hong Kong in 1864 a remarkable amount of money flowing through the colony. The tea trade, the silk trade, the increasingly significant trade in opium. That specific commodity, whose forced introduction into the Chinese market had triggered 2 wars and the cession of Hong Kong to Britain in the first place, were generating commercial flows of a scale that the existing banking infrastructure of the colony was utterly inadequate to handle. The banks that served Hong Kong in 1864 were almost without exception banks headquartered in London or Calcutta or Bombay, institutions whose management sat thousands of miles away from the markets they were supposed to be serving, whose decision-making was governed by policies designed for conditions that bore little resemblance to the specific realities of the China trade, and whose ability to respond quickly to the fast-moving commercial opportunities of the Asian market was severely constrained by the communications technology of the era. A letter from Hong Kong took weeks to reach London. A decision that needed London's approval could not be made in time to matter. What the merchants gathered in that Hong Kong counting house wanted was a bank that understood Asia because it was of Asia, headquartered in the region, managed by people who lived in the region, governed by policies designed for the specific conditions of the China trade, rather than adapted from templates designed for the Thames or the Ganges. They founded the Hong Kong and Shanghai Banking Corporation on March 3, 1865. 160 years later, that institution, now known as HSBC, is one of the largest banks in the world. It operates in 62 countries and territories. It serves approximately 40 million customers. Its total assets exceed $3 trillion, making it one of the 6 or 7 largest financial institutions on Earth by that measure. It employs approximately 220,000 people. Its market capitalization, which fluctuates with the share price, has at various points exceeded $200 billion. But the story of HSBC is not simply a story of growth from small beginnings to global scale. It is a story about the relationship between banking and empire, about how financial institutions are shaped by the specific historical contexts in which they are founded, and how those origins persist in ways both visible and invisible, long after the contexts that produced them have changed beyond recognition. It is a story about the opium trade and the Opium Wars that defined the world into which the bank was born. It is a story about Hong Kong, the colony that was the bank's home for over a century, the city whose extraordinary economic development the bank both financed and embodied, and the political complexity of whose eventual handover to China the bank had to navigate with consequences that are still unfolding. And it is, in ways that the bank's current management would prefer to discuss in careful, measured terms, a story about money laundering, drug cartel financing, sanctions violations, and the specific kind of institutional behavior that results when a bank becomes so large, so complex, and so deeply embedded in so many different political and regulatory environments that it loses the ability to control what is done in its name. This is that story. And it begins not in London, not in New York, but on the waterfront of a rocky island that Britain had seized from China 23 years earlier as the spoils of a war fought, in large part to protect the right to sell opium. Hong Kong, 1842. The Treaty of Nanking, which formally ended the First Opium War between Britain and the Qing dynasty, had ceded the island of Hong Kong to Britain in perpetuity. The island was rocky, sparsely inhabited, and possessed a few obvious natural resources. What it had was a deep natural harbor, one of the finest in Asia, and a location at the mouth of the Pearl River Delta that made it ideally positioned as a trading post for the commerce between the Chinese mainland and the wider world. The British merchants and officials who began arriving in Hong Kong in the early 1840s were not for the most part idealists or adventurers. They were businessmen. The purpose of Hong Kong, as they understood it, was commercial, to serve as the entrepot through which British trade with China would flow, and in particular to serve as the base from which the China trade's most profitable commodity would be managed. That commodity was opium. The opium trade requires some explanation for a modern audience, because its scale and its significance in the commercial history of Asia are frequently understated in the standard accounts of British imperial history. Opium, produced primarily in Bengal in India, under the management of the British East India Company, was the commodity that the British had discovered, after decades of frustrated searching, that China would actually buy in large quantities. The trade balance between Britain and China had long been a source of concern to British merchants and officials. Britain wanted Chinese goods, silk, tea, porcelain, but China wanted almost nothing from Britain in return, preferring to be paid in silver. The result was a persistent drain of silver from Britain to China that the British commercial establishment found both irritating and economically damaging. Opium changed this. The introduction of Bengal opium into the Chinese market in the late 18th century created a demand that grew rapidly, too rapidly for the Qing government's comfort, which attempted to ban the trade and to prevent the silver drain in reverse direction that the opium trade was creating. The British response to the Qing ban was, in retrospect, one of the most shameful episodes in the history of British imperialism. 2 Opium Wars, fought explicitly to preserve the right to sell an addictive substance to a population whose government had asked for the trade to stop. The First Opium War of 1839 to 1842 ended with the Treaty of Nanking, which ceded Hong Kong to Britain, opened 5 Chinese ports to foreign trade, and extracted a substantial indemnity. The Second Opium War of 1856 to 1860 expanded these concessions further, opening more Chinese ports, ceding the Kowloon Peninsula to Britain, and further entrenching the commercial privileges of foreign merchants in China. Hong Kong in the 1840s and 1850s was therefore, quite literally, a colony whose existence and commercial purpose were directly connected to the opium trade. The merchants who settled there, the trading houses that would later become known as the Great Hong Kong Hongs, the commercial establishments that dominated Asian trade for a century, were many of them directly involved in the opium trade as their primary business. Jardine, Matheson and Company, which was the most powerful merchant house in Hong Kong, and which would be one of the founding shareholders of the Hong Kong and Shanghai Banking Corporation, had been built substantially on the profits of the opium trade. This is the context into which the bank that became HSBC was born. Not a neutral commercial context, not the straightforward story of merchants creating financial infrastructure to serve legitimate trade. A context in which the most important commodity, the one that generated the most profit and structured the most significant commercial relationships, was a drug whose forced introduction into China had required 2 wars to achieve. The founding of the Hong Kong and Shanghai Banking Corporation in 1865 needs to be understood against this background, not because the bank was simply an opium bank, which is an oversimplification, but because the world in which it was founded was a world shaped fundamentally by the opium trade and by the specific commercial and political relationships that the trade had created. Understanding what HSBC is today requires understanding what it was born into. The specific circumstances of the Hong Kong and Shanghai Banking Corporation's founding in 1865 reflected the commercial logic of the China trade with a directness that later institutional histories tend to soften. The man most responsible for organizing the founding was Thomas Sutherland, a Scotsman working for the Peninsular and Oriental Steam Navigation Company in Hong Kong. Sutherland was not himself a banker. He was a shipping man, but he had observed the inadequacy of the existing banking arrangements for Hong Kong's commercial needs, with the practical frustration of someone whose business required financial services that the available institutions were not providing effectively. The specific problem that Sutherland identified was the absence of a bank capable of providing short-term trade finance on terms appropriate to the China trade. The existing banks, the Oriental Banking Corporation, the Chartered Mercantile Bank of India, London and China, were adequately capitalized but managed from London, which meant that their credit decisions were made by people who did not understand the specific risks and opportunities of the China market. A merchant in Hong Kong who needed a credit line to finance a shipment of goods could find himself waiting weeks for a decision that should have taken days, by which time the commercial opportunity had either passed or been taken by a competitor with faster access to credit. Sutherland's solution was a bank that would be headquartered in Hong Kong itself, managed from the colony, governed by directors who lived and worked in the region, and designed specifically for the conditions of the China trade. He circulated a prospectus to the major commercial houses of Hong Kong and Shanghai in late 1864, proposing the establishment of a local bank with initial capital of $5 million, to be raised by subscription from the local merchant community. The response was rapid and enthusiastic. The major trading houses of Hong Kong, Jardine, Matheson, Dent and Company, the Bombay and Bengal houses that had established themselves in the colony, subscribed capital to the speed that reflected both their genuine commercial need for better banking services and their recognition that a locally managed bank would give them influence over the credit decisions that shaped their businesses. The founding shareholders were not a random selection of Hong Kong's commercial community. They were the most powerful trading houses in the colony, and their interests in the specific commodities and the specific commercial relationships that constituted the China trade shaped the bank's early operations in ways that are worth understanding directly. Jardine, Matheson and Company, the dominant trading house in Hong Kong and a firm whose commercial history was inseparable from the opium trade, was among the most significant founding shareholders. The commercial activities that these houses conducted, the movement of goods between India, China, Southeast Asia, and the wider world, were the activities that the bank was designed to finance. The opium trade was not the only trade that the bank financed in its early years. It also financed the tea trade, the silk trade, the cotton trade, and the various other commercial flows that constituted the China market. But opium was the most profitable commodity in the market, the one that generated the most significant trade flows, and the one whose specific commercial requirements, large short-term credit lines for the purchase of Bengal opium, letters of credit for its shipment to China, exchange services for the conversion of the silver payments received from Chinese buyers, were among the most significant banking services that the new institution provided. This is not a comfortable fact, and it is one that HSBC's institutional history has not always engaged with directly. The bank's official histories tend to describe the early period in terms of the general China trade, acknowledging the opium dimension in passing, but not dwelling on it in ways that might seem to implicate the institution in something for which a modern reader would rightly feel revulsion. The honest account is that the bank was founded in a commercial environment in which the opium trade was central, that its founding shareholders were directly involved in that trade, and that the banking services it provided in its early years were used to finance the trade alongside the other commodities of the China market. The bank grew rapidly from its founding. The combination of local management, adequate capitalization, and the genuine commercial need it was meeting produced results that confirmed Sutherland's commercial instinct. By the end of its first year of operation, the Hong Kong and Shanghai Banking Corporation had established itself as the preeminent banking institution in Hong Kong, and it was opening its first branches in Shanghai and the other treaty ports that the Opium Wars had forced open to foreign trade. The branch network that the bank built in its first decade, spanning Hong Kong, Shanghai, the Chinese treaty ports, Singapore, the Straits settlements, and the major ports of Southeast Asia, was a direct reflection of the commercial geography of the China trade. The bank followed the trade routes, establishing itself wherever the merchants who were its clients needed banking services, and wherever the specific commercial flows of Asian trade generated the need for credit, exchange services, and the movement of funds. By the 1880s, the Hong Kong and Shanghai Banking Corporation had established itself not just as Hong Kong's leading bank, but as the dominant financial institution in the broader Asian trade network. Its balance sheet had grown to a size that made it one of the most significant banks in Asia. Its relationships with the merchant houses of Hong Kong and Shanghai, with the colonial governments of British Asia, and with the various Asian commercial communities that participated in the trade networks it served, had given it a position of genuine financial dominance in the region. It was also, by this point, doing something that the founding prospectus had not anticipated, but that proved to be one of the most consequential dimensions of its development. It was becoming a banker to governments. The transition from a trade finance bank to a government banker was not planned. It emerged from the specific opportunities that the bank's position in Asia presented as the colonial and post-colonial financial landscape of the region developed through the late 19th and early 20th centuries. The first and most significant government banking relationship that the Hong Kong and Shanghai Banking Corporation developed was with the government of Hong Kong itself. As the colony's commercial bank, the institution that managed the flow of funds through the colony's economy and that had the deepest knowledge of the colony's financial conditions, the bank naturally became the government's banker, managing the government's accounts, financing the government's short-term cash flow needs, and providing the exchange services that the colonial administration required. This relationship, established in the earliest years of the bank's existence, gave it a structural position in the colony's financial system that was difficult for any competitor to challenge. The relationship with the Chinese imperial government was more complex and more consequential. The Qing dynasty, facing the financial pressures of the late 19th century, the indemnities imposed by the Opium Wars, the costs of suppressing internal rebellions, the financial requirements of a modernization program that the dynasty's leadership recognized as necessary but struggled to fund, was a significant potential borrower. And the Hong Kong and Shanghai Banking Corporation was the institution best positioned to arrange the loans that the Qing government needed. The bank's first major loan to the Chinese government came in 1874, a modest advance that established the relationship and demonstrated the bank's willingness to lend to the Qing government despite the political risks involved. The subsequent decades saw the relationship develop substantially. As the Qing government's borrowing needs grew, and as the bank's capacity to arrange international loans, syndicating participation to European investors, expanded. The most significant of the early Chinese government loans was the Indemnity Loan of 1895, arranged after the Sino-Japanese War had imposed a massive indemnity payment on China that the Qing treasury could not meet from its own resources. The Hong Kong and Shanghai Banking Corporation, working with other major banks and with the backing of the British government, arranged the financing that allowed China to pay the indemnity at terms that were, from the Chinese perspective, onerous. But that represented the best available option in a market where China's creditworthiness was regarded with considerable skepticism. The government lending business brought the bank into an increasingly explicit relationship with the political dimensions of Asian finance, with the great power rivalries that structured the late 19th century competition for influence in China and Southeast Asia, with the specific interests of the British government in maintaining commercial access to the Chinese market, and with the complex politics of a decaying Chinese imperial system that was simultaneously being pressured by foreign powers and internally challenged by the forces of reform and revolution. The bank's role in these political dynamics was not that of a neutral financial intermediary. It was, explicitly, an instrument of British commercial and political interests in Asia, an institution that the British government used, informally but consistently, as a vehicle for extending British financial influence in the region. The bank's lending to the Chinese government was not simply a commercial transaction. It was part of a broader British strategy of economic engagement with China that sought to maintain British commercial privileges through the extension of credit and the establishment of financial dependence. This role as an instrument of imperial finance was most visible in the bank's involvement in the financing of Chinese railway construction. The great railway building programs of the late Qing period were financed substantially through foreign loans, and the competition between Britain, France, Germany, Russia, and Japan for the privilege of financing specific railway lines was a proxy competition for political and commercial influence in the specific regions through which the railways would pass. The Hong Kong and Shanghai Banking Corporation participated actively in this competition, arranging loans for railway construction that served British commercial and strategic interests. The involvement in railway finance was also the context in which the bank's relationship with the emerging Republican China, the government that replaced the Qing dynasty after the 1911 revolution, was established. The various successor governments of early 20th century China, whatever their political character, faced the same fundamental fiscal challenge that had confronted the Qing dynasty: insufficient domestic revenue to finance the investment that economic development required. Foreign borrowing was the solution, and the Hong Kong and Shanghai Banking Corporation remained one of the primary instruments through which Chinese government borrowing was arranged. The bank's government banking activities extended well beyond China. In the colonial territories of British Asia, Malaya, Burma, Ceylon, the Straits Settlements, the bank served as the de facto central bank, managing currency issues, maintaining the financial infrastructure of colonial administration, and providing the banking services that colonial governments required. This role gave it a structural position in the financial systems of these territories that was, in practical terms, equivalent to a public function, even though the bank was a private institution operating for profit. The Japanese market was another significant dimension of the bank's regional presence. The bank established itself in Yokohama in 1866, just 1 year after its founding, and its relationship with the Japanese financial system developed through the Meiji era as Japan modernized its economy and sought foreign capital for the industrial development that modernization required. The bank's participation in Japanese government lending and its role in the development of the Japanese financial market gave it a position in what would prove to be the most dynamic economy in Asia for most of the 20th century. By the early 20th century, the Hong Kong and Shanghai Banking Corporation was not simply a bank. It was the financial architecture of British Asia. Its balance sheet, its network, its government relationships, and its role in the currency and payment systems of the region made it something closer to a quasi-official institution than a purely private one. Understanding what it was requires understanding that the distinction between public and private, between commercial and political, was genuinely blurred in the specific context of British imperial finance in Asia in ways that have no direct modern equivalent. The first decades of the 20th century tested the Hong Kong and Shanghai Banking Corporation in ways that its founders could not have anticipated, and that its institutional resilience, accumulated across half a century of operation in the most commercially dynamic and politically volatile region in the world, proved adequate to survive. The First World War disrupted the bank's European operations and its relationships with the German commercial houses that had been significant participants in the Asian trade networks it served. Germany's exclusion from the Allied trading system during the war years disrupted the commercial flows that the bank had been financing, and the post-war restructuring of the global trading system required significant adaptation. But the war's most significant effect on the bank was indirect. It accelerated the decline of British commercial dominance in Asia by draining British capital and attention toward the European theater, creating space for American and Japanese commercial expansion into markets that had previously been British preserves. The interwar period saw the bank navigate the turbulent politics of China, the warlord era, the Northern Expedition, the establishment of the nationalist government, the growing conflict between the nationalists and the communists, with the pragmatic flexibility of an institution whose primary commitment was to the continuation of commercial activity rather than to any specific political order. It maintained relationships with successive Chinese governments, regardless of their political character, on the practical grounds that the alternative, withdrawal from the Chinese market, was commercially unacceptable. The Japanese invasion of China, which began in earnest in 1937, presented a more severe challenge. The bank's operations in Shanghai, the most commercially significant of its China branches, were disrupted by the Japanese capture of the city's international settlement in December 1941, the same day as the attack on Pearl Harbor that brought the United States into the war. The Hong Kong branch was captured when Japan overran the colony in December 1941, and the bank's Hong Kong operations were effectively suspended for the duration of the Japanese occupation. The occupation of Hong Kong from December 1941 to August 1945 was one of the most traumatic periods in the colony's history and in the bank's institutional memory. The Japanese military administration confiscated the bank's assets, forced the bank to operate under Japanese supervision, and used the bank's facilities, its branches, its vaults, its payment systems, for the purposes of the occupation economy. The senior British staff of the bank were interned in prisoner of war camps where several died. The specific experience of occupation produced in the bank's post-war leadership a set of institutional commitments to the preservation of Hong Kong's commercial character, to the maintenance of the financial infrastructure that the colony's prosperity depended on, and to the political stability that commercial activity required, that shaped its strategy for the following 4 decades. The lesson that the bank drew from the occupation was not that banks should be more cautious about operating in politically unstable environments. It was that the bank's presence in Hong Kong was itself a form of political and commercial commitment, that the bank's willingness to stay, to invest, to maintain its operations through difficult circumstances was part of what made Hong Kong work as a commercial center. The post-war reconstruction of Hong Kong, which transformed the colony from the battered, impoverished and depopulated territory that emerged from Japanese occupation into the dynamic commercial and industrial center that it would become by the 1970s, was financed substantially through the bank. The reconstruction required capital for rebuilding physical infrastructure, for establishing the industrial base that would absorb the enormous wave of immigration from mainland China that followed the Communist Revolution of 1949, for developing the financial system that Hong Kong's growing economy required. The Hong Kong and Shanghai Banking Corporation provided much of this capital, expanding its balance sheet, developing new lending products, and building the financial infrastructure that the reconstruction required. The Communist Revolution of 1949 and the establishment of the People's Republic of China created a specific challenge for the bank's China operations. The new government's approach to foreign banks was initially not outright confiscation. The communist government needed the banking services that foreign banks provided for China's international trade, and it was not immediately in a position to replace them with domestic alternatives. The bank continued to operate in Shanghai and the other treaty ports under the new government, managing a delicate relationship with Chinese communist authorities who were simultaneously using its services and regarding it with ideological suspicion. The Korean War, which brought American-led trade sanctions against China, created the context in which the bank's China operations became untenable. Unable to operate effectively under the sanctions regime and unwilling to become a vehicle for sanctions evasion on the scale that would have been required to maintain a meaningful China presence, the bank substantially withdrew from mainland China in the early 1950s. The withdrawal concentrated the bank's Chinese operations in Hong Kong, which remained a British colony outside the sanctions regime, and reinforced the colony's role as the primary locus of the bank's Asian business. The decades from the 1950s through the 1970s were, for the bank, a period of extraordinary commercial success, built on the extraordinary commercial success of Hong Kong itself. The colony's transformation from a refugee-receiving entrepot into a manufacturing hub and then into a financial center of global significance was the most important economic story in Asia during these decades, and the bank was at the center of it, financing the factories, providing the trade finance, managing the foreign exchange, and building the financial infrastructure that Hong Kong's growing economy required. The transformation of the Hong Kong and Shanghai Banking Corporation from a regional Asian bank into a genuinely global financial institution began in the 1980s and accelerated through the 1990s in a series of acquisitions and strategic moves that reflected both the specific commercial logic of global banking in the era of financial liberalization and the specific anxiety of a bank whose home territory, Hong Kong, was scheduled for transfer to China in 1997. The anxiety about Hong Kong's future was real, and it shaped strategy in ways that the bank's management did not always articulate publicly, but that were evident in the pattern of decisions made during the decade before the handover. A bank that was 90% dependent on a single territory, however commercially dynamic that territory was, and that faced the prospect of that territory being absorbed by a government with a fundamentally different approach to private banking, was a bank with a serious strategic vulnerability. The solution was diversification, the construction of a global presence that would make the bank's fortunes less dependent on any single territory or political jurisdiction. The first major move in the global diversification strategy was the acquisition of a controlling stake in the Marine Midland Bank in the United States in 1980. Marine Midland was a regional American bank headquartered in Buffalo, New York, with a network across New York State and a balance sheet that made it a significant presence in American retail banking. The acquisition gave the Hong Kong and Shanghai Banking Corporation a foothold in the world's largest banking market and a dollar-denominated asset base that reduced its dependence on Hong Kong dollar assets. The Marine Midland acquisition was followed in 1987 by the acquisition of a majority stake in the British bank Midland Bank. Midland was, at the time of the acquisition, one of the four major British clearing banks, an institution with millions of retail customers across Britain, a substantial corporate banking operation, and a balance sheet that made it one of the largest banks in the United Kingdom. The acquisition was not immediately completed. The Hong Kong and Shanghai Banking Corporation's initial stake of approximately 15% was gradually increased through the late 1980s and early 1990s, with the full acquisition completed in 1992. The Midland acquisition transformed the character of the institution. The Hong Kong and Shanghai Banking Corporation had been, until this point, primarily an Asian bank with some international presence. With the addition of Midland, it became a genuinely global institution, with major retail and corporate banking operations in Britain, the United States, and Asia, and a combined balance sheet that put it among the largest banks in the world. The strategic logic of the Midland acquisition was clear. Britain was a major financial center with a large domestic banking market, a global network of relationships from its imperial past, and a regulatory environment that was, in the post-Big Bang era, relatively open to foreign ownership of domestic financial institutions. Midland's retail network and its corporate banking relationships gave the combined institution access to the British market that would have taken decades to build organically. The combined institution needed a corporate structure that reflected its genuinely global character. In 1991, the Hong Kong and Shanghai Banking Corporation reorganized itself as HSBC Holdings plc, a new parent company incorporated in England and Wales, with shares listed on the London Stock Exchange as well as in Hong Kong. The reorganization moved the legal domicile of the institution from Hong Kong to London, which was both a strategic decision about the institution's long-term home and a signal about the bank's assessment of the political risks associated with the forthcoming handover of Hong Kong to China. The new name, HSBC, derived from the initials of the Hong Kong and Shanghai Banking Corporation, was simpler and more internationally usable than the full name, which carried connotations of a specifically Asian and colonial past that the institution was attempting to transcend as it built its global identity. The rebranding was part of a broader process of institutional reinvention that accompanied the structural reorganization. The 1990s saw HSBC continue its acquisitive expansion with a focus on the emerging markets that the bank's Asian heritage had given it particular insight into. The acquisition of Banco Bamerindos in Brazil in 1997, the purchase of Roberts S.A. do Inversions in Argentina in 1997, and various other acquisitions in Latin America, the Middle East, and other emerging markets built the institution's presence in the high-growth markets that the bank's management believed would be the most commercially significant in the coming decades. The most significant acquisition of the 1990s, however, was not in an emerging market. In 1999, HSBC acquired the Republic New York Corporation and Safra Republic Holdings, financial institutions associated with the Safra banking family, in a transaction that further strengthened the bank's position in the American market and brought it a significant private banking operation serving wealthy international clients. The acquisition strategy was not universally successful. The Household International acquisition in 2003, a large American consumer finance company that HSBC purchased for approximately $14 billion, attracted by its substantial portfolio of subprime mortgage and consumer lending, proved to be one of the most costly strategic mistakes in the bank's history. Household's aggressive lending practices, which had generated significant regulatory attention before the acquisition, proved to be a harbinger of the broader subprime crisis that would erupt in 2007 and 2008. HSBC's exposure to Household's deteriorating loan portfolio was one of the factors that made the bank one of the first major global institutions to publicly acknowledge the scale of the subprime problem, announcing in February 2007, months before the broader crisis became apparent, that its credit loss provisions would be significantly higher than previously estimated. The Household acquisition illustrated a recurring pattern in HSBC's acquisition strategy: the tendency to pay premium prices for acquisitions in markets where the bank's existing presence was limited, based on strategic assessments of growth potential that proved in some cases to be overly optimistic. The combination of rapid geographic expansion and the complexity of integrating acquisitions made in multiple regulatory environments created management challenges that a more focused institution would not have faced. On July 1, 1997, at midnight, the flag of the United Kingdom was lowered in Hong Kong, and the flag of the People's Republic of China was raised. The handover of Hong Kong, the event that British and Chinese diplomats had been negotiating since the early 1980s, and that had been the source of more anxiety in the Hong Kong business community than almost any other political event of the 20th century, was complete. For HSBC, the handover was the culmination of a decade of preparation. The reorganization as HSBC Holdings plc with a London domicile, the acquisition of Midland, the diversification of the balance sheet across multiple geographies. All of these had been motivated, at least in part, by the need to reduce the bank's dependence on Hong Kong before the handover transferred the colonies' governance to a government that the bank's management regarded with genuine uncertainty. The uncertainty was not primarily about China's economic intentions. The Chinese government had made clear, through the framework of the basic law that governed Hong Kong's post-handover status, that it intended to maintain Hong Kong's economic system and its financial infrastructure essentially unchanged for 50 years. The uncertainty was about how that commitment would be maintained in practice, about whether the political pressures that would inevitably develop within China toward greater control over the territory's institutions would be resisted, and about whether a bank headquartered in London with its primary Asian operations in Hong Kong would be able to maintain the same commercial freedom in a post-handover environment that it had enjoyed under British governance. The handover, as it happened, was less disruptive than many in the Hong Kong business community had feared. The financial crisis that struck Asia in the second half of 1997, the Asian financial crisis, which caused dramatic currency depreciations and economic contractions across Thailand, Indonesia, South Korea, and Malaysia, was a far more immediate threat to Hong Kong's financial stability than the political transition. The defense of the Hong Kong dollar's peg to the US dollar, which the Hong Kong Monetary Authority and the Hong Kong government mounted at enormous cost during the crisis, was a demonstration of the post-handover government's commitment to the financial stability that Hong Kong's status as an international financial center required. HSBC navigated the Asian financial crisis with the resilience of an institution that had been through previous Asian crises and that had the geographic diversification, the American operations, to absorb losses in its Asian portfolio without threatening its overall financial stability. The crisis cost the bank money and required significant provisions against bad debts in the affected countries, but it did not threaten the institution's fundamental viability in the way that it threatened some of the more concentrated Asian financial institutions. The China question, the question of how HSBC would position itself relative to the enormous opportunity represented by the mainland Chinese market, was the most consequential strategic question of the post-handover period. China's economy was growing at rates that made it the most important emerging market story in the world, and the financial services sector was one of the most significant opportunities within that story. A bank with HSBC's Asian heritage, its Hong Kong presence, and its Cantonese-speaking management and client base was in some respects better positioned to exploit the China opportunity than any of its major competitors. The specific mechanism through which HSBC pursued the China opportunity was a substantial investment in the Bank of Communications, one of China's major state-owned banks. In 2004, HSBC acquired a 19% stake in the Bank of Communications, just below the threshold that would have required regulatory approval for a foreign bank to hold a controlling stake, for approximately $1.7 billion. The investment gave HSBC a significant financial exposure to the Chinese banking market and a relationship with one of the major Chinese state banks that could serve as a platform for further China expansion. The Bank of Communications investment was also explicitly a strategic statement. It signaled to Chinese regulators and to the Chinese government that HSBC regarded China as its most important long-term market, that the bank, with roots in the Hong Kong and Shanghai Banking Corporation, was committed to the Chinese market in a way that went beyond the opportunistic participation of a purely Western institution. The signal was important because access to the Chinese banking market was governed by regulatory decisions that required Chinese government goodwill, and demonstrating that goodwill required exactly the kind of long-term commitment that the Bank of Communications investment represented. The China strategy was not without complications. The regulatory environment for foreign banks in China was restrictive in ways that limited the products they could offer, the clients they could serve, and the geographic reach of their operations. The process of obtaining licenses to open new branches, to offer new products, and to expand the customer base was slow, bureaucratically demanding, and subject to political considerations that had no direct commercial logic. HSBC invested substantially in navigating this regulatory environment, in the relationships with Chinese regulators and officials that were the prerequisite for obtaining the approvals that China expansion required. The relationship between HSBC's commercial interests in China and the political pressures that the Chinese government's growing assertiveness created was a recurring source of tension in the post-handover years. A bank with major operations in mainland China, a headquarters in London, and retail operations across the democratic world occupied a genuinely difficult position when the Chinese government's policies conflicted with the values or the regulatory requirements of the other jurisdictions in which the bank operated. This tension would become more acute in the years following the 2019 pro-democracy protests in Hong Kong, when HSBC was placed in the specific and uncomfortable position of having to choose, publicly, between supporting the national security legislation that the Chinese government imposed on Hong Kong and maintaining the image of a politically neutral international financial institution. The bank's response to this pressure, the decision by HSBC's Asia CEO in 2002 to sign a petition supporting the national security legislation, at a time when the legislation was being widely criticized by Western governments and human rights organizations, generated exactly the kind of controversy that the bank's management had spent years trying to avoid. It satisfied neither the Chinese government, which continued to regard HSBC with residual suspicion from the Huawei controversy that had preceded it, nor the Western critics, who saw the bank's signature on the petition as a capitulation to political pressure. The episode was a compressed illustration of the fundamental tension in HSBC's strategic position, a bank too deeply embedded in China to refuse Chinese political demands, and too deeply embedded in Western financial systems to accept those demands without consequences. On December 11, 2012, HSBC entered into a deferred prosecution agreement with the United States Department of Justice, under which the bank agreed to pay $1.92 billion in fines and penalties. At that time, the largest settlement ever reached between a bank and the US government to resolve allegations of money laundering, sanctions violations, and the financing of drug cartels. The settlement was the culmination of a multi-year investigation by US federal prosecutors, the Senate Permanent Subcommittee on Investigations, and regulators from multiple countries into the bank's compliance with anti-money laundering laws, and with the sanctions that the United States imposed on countries including Iran, Libya, Sudan, Cuba, and Burma. The findings were comprehensive, detailed, and deeply damaging to an institution that had built much of its commercial identity around the claim of being a responsible, well-governed global bank. The Senate Subcommittee's report, released in July 2012, documented in extraordinary detail the specific failures of HSBC's compliance operations. The bank's Mexican affiliate, HSBC Mexico, had been used by the Sinaloa drug cartel and other Mexican and Colombian drug trafficking organizations to launder drug trafficking proceeds, moving hundreds of millions of dollars of drug money through HSBC's banking system by exploiting deficiencies in the bank's anti-money laundering controls. The scale of the money laundering was staggering. The subcommittee documented approximately $880 million in drug trafficking proceeds laundered through HSBC between 2002 and 2010. The specific mechanics of the money laundering are worth understanding because they reveal something important about how the failures occurred. The Sinaloa cartel and its associates were depositing large amounts of US dollar cash, physical banknotes, in boxes at HSBC Mexico branches to be transferred to HSBC accounts in the United States. The cartel had developed specific box sizes for the deposits that were designed to fit through the teller windows of HSBC Mexico branches, a detail that captures both the industrial scale of the operation and the degree to which the cartel had adapted its logistics to the specific features of the bank's physical infrastructure. The anti-money laundering controls that should have detected and prevented this activity were, according to the Senate report and the prosecutor's findings, systematically inadequate. The bank's compliance staff were overwhelmed. The volume of transactions to be reviewed exceeded the capacity of the compliance team to review them effectively. The compliance software was outdated. The management culture prioritized the generation of fee income over the rigorous enforcement of compliance rules, creating a dynamic in which compliance concerns were systematically subordinated to commercial pressures. The sanctions violations were a separate but equally serious dimension of the findings. HSBC's affiliates in various countries had processed transactions with entities in Iran, Libya, Sudan, Cuba, and Burma in ways that violated the sanctions that the United States had imposed on those countries. The specific mechanisms included the stripping of identifying information from wire transfers, removing the names of sanctioned entities from the messages that accompanied the transactions, so that the transactions would not be flagged by the automated sanction screening systems of US correspondent banks through which the transactions were routed. The Iranian sanctions violations were particularly extensive. HSBC's Middle Eastern affiliate had processed thousands of transactions involving Iranian entities that should have been blocked under US sanctions. The transactions had been structured in ways that concealed their Iranian origin, routing them through accounts that did not identify the Iranian connection, with the knowledge and sometimes the explicit cooperation of HSBC employees. The scale and duration of the failures documented in the investigation raised questions that went beyond the specific compliance breakdowns to the broader question of how an institution of HSBC's size and sophistication could have allowed these failures to persist for years without detection and correction. The Senate report's answer was essentially cultural, that HSBC had a management culture in which compliance was systematically undervalued relative to commercial performance, in which the people responsible for compliance were underfunded and understaffed relative to the revenue-generating parts of the business, and in which the pressure to meet commercial targets created incentives to overlook or minimize compliance concerns. The Deferred Prosecution Agreement imposed substantial obligations on HSBC beyond the financial penalty. The bank was required to retain an independent compliance monitor, a former federal judge who would assess the bank's compliance with the terms of the agreement and report to the Department of Justice on the bank's progress in remedying its compliance failures. The monitor's role was explicitly supervisory. He had the authority to assess the bank's operations, to interview management, and to review documents in ways that gave him visibility into the bank's internal workings that went well beyond what normal regulatory oversight would provide. The compliance monitor's reports, which were filed with the Department of Justice over a 5-year period, documented a gradual improvement in HSBC's compliance systems and culture, evidence that the enormous investment in compliance infrastructure that the bank made in the years following the settlement was producing results. The Deferred Prosecution Agreement was ultimately resolved without prosecution, consistent with its terms. In 2017, the money laundering scandal had consequences for the bank that went beyond the financial penalties and the compliance remediation costs. It damaged the institution's reputation in ways that took years to repair, creating a specific association between the HSBC name and the concept of inadequate compliance that persisted in the public consciousness long after the specific failures had been addressed. It contributed to a broader reconsideration of the management culture and the strategic priorities that had produced those failures, and it triggered a period of significant senior management change. The resignations and retirements of several senior executives who had been associated with the compliance failures, and the appointment of new leadership explicitly tasked with the cultural transformation that the failures had made necessary. The scandal also raised broader questions about the specific risks that come with operating a genuinely global bank, a bank with operations in dozens of countries across multiple regulatory regimes, serving clients across the full spectrum of the global economy. The complexity of managing compliance across such an institution is genuinely extraordinary, and the failures that the HSBC investigation documented were not unique to HSBC. Similar failures had been documented at other major global banks, and the regulatory response to those failures was reshaping the compliance requirements of the entire industry. But HSBC's failures were among the most extensively documented and the most publicly discussed, and they became a reference point in the broader conversation about the risks of global banking complexity. In December 2018, Canadian authorities arrested Meng Wanzhou, the chief financial officer of Huawei Technologies and the daughter of the company's founder, at Vancouver's International Airport. The arrest was made at the request of the United States government, which had issued an arrest warrant based on allegations that Meng had made false statements to HSBC in connection with Huawei's business in Iran, statements that, the US prosecutors alleged, had caused HSBC to violate American sanctions against Iran by processing transactions related to Huawei's Iranian business. The arrest placed HSBC in one of the most politically exposed positions that any commercial institution has occupied in the modern era. The bank had provided documents to US authorities as part of the sanctions investigation, documents that formed part of the evidentiary basis for the arrest warrant, and it had done so in compliance with US legal requirements that gave it no practical choice. But from China's perspective, HSBC was a foreign bank that had provided information to US authorities that had led to the arrest of a prominent Chinese citizen and the daughter of the founder of one of China's most strategically important technology companies. China's response to the arrest was immediate and multifaceted. The Chinese government arrested 2 Canadian citizens, Michael Kovrig and Michael Spavor, in what was widely understood as a form of hostage diplomacy, attempting to create pressure for Meng's release by detaining Canadian nationals in China. The Chinese state media launched a sustained campaign critical of the US approach to the Huawei case, framing it as an attempt to suppress a successful Chinese technology company through legal means. And Chinese officials made clear, through various channels, that HSBC's role in the affair, its cooperation with US authorities, had not been forgotten. The specific pressure on HSBC took multiple forms. Chinese state media outlets published articles that were critical of the bank, characterizing its cooperation with US authorities as a betrayal of its Chinese clients. Chinese regulatory officials communicated, through both formal and informal channels, their expectation that HSBC would take a more constructive approach to the Huawei matter, a communication that the bank understood clearly even if it was not framed as an explicit threat. And the Bank of Communications Investment, HSBC's most significant China asset, became a point of leverage through which the Chinese government could, if it chose, create financial pressure on the institution. HSBC's response to this pressure was constrained by the same structural reality that had shaped its position throughout the post-handover period. It was too embedded in both the American and the Chinese financial systems to satisfy either power fully when those powers were in direct conflict. It could not publicly criticize the US government's sanctions enforcement without risking its compliance standing and its access to the US dollar clearing system. It could not publicly support the US position without risking its relationships with Chinese regulators and its China business. The bank attempted to navigate this impossible position through careful silence and neutral language, avoiding public statements that would clearly align it with either side, communicating privately with both US and Chinese authorities in ways that were intended to manage the relationship with each without publicly antagonizing the other. This strategy, which reflected the bank's general approach to politically sensitive situations, satisfied neither party and created the impression, damaging to an institution that depends on trust, of an institution trying to have it both ways. The 22 decision by HSBC's Asia-Pacific CEO, Noel Quinn, to sign a petition supporting China's national security legislation for Hong Kong, legislation that was widely condemned by Western governments, human rights organizations, and the Hong Kong pro-democracy movement, was the moment at which the bank's navigational strategy collapsed most visibly. The signature was interpreted, in the Western press and by Western governments, as a capitulation to Chinese political pressure. It was interpreted in China as insufficient, coming as it did with caveats and careful language that fell short of the unequivocal endorsement that the Chinese government's allies in Hong Kong were expressing. The episode illustrated a structural truth about HSBC's strategic position that no amount of careful communication could obscure. A bank headquartered in London, with its largest single market in China, operating in an era of increasing geopolitical competition between the United States and China, was inevitably going to be caught between the two powers in ways that would make it impossible to maintain the politically neutral stance that global commercial banking ideally requires. The Huawei affair was not resolved quickly. Meng Wanzhou remained under house arrest in Vancouver for nearly 3 years, from December 2018 to September 2021, before reaching a deferred prosecution agreement with US authorities that allowed her to return to China. The resolution removed the most acute pressure from the situation, but did not restore the relationships between HSBC and its various political stakeholders to the status quo ante. The episode had revealed, too clearly for any subsequent management to ignore, the specific risks that came with operating as the bridge bank between the Western financial system and the Chinese financial system in an era when those systems were increasingly in tension. The question of where HSBC's strategic home ultimately lay, whether it was fundamentally a Western bank with Asian operations or an Asian bank with Western operations, was brought into sharp focus by the Huawei affair and its aftermath. The bank's major institutional shareholders, many of whom were based in Asia and had significant exposure to the bank's Asian earnings, had a different perspective on this question than the bank's Western regulators, its British political stakeholders, and the institutional investors who held the bank's London-listed shares. Managing these different perspectives, each legitimate, each backed by significant financial and political weight, was the central challenge of HSBC's leadership in the years following the Huawei crisis. HSBC in 2200 is an institution in the midst of a strategic rethinking that goes to the core of what the bank is and what it should become. The questions that the Huawei affair and its aftermath forced into the open questions about the bank's strategic home, its relationship with China, its positioning in the US-China geopolitical competition, have produced a sustained period of internal debate and external pressure that is reshaping the institution in ways whose full implications are not yet entirely clear. The most visible expression of this rethinking has been the ongoing discussion, sometimes public, sometimes conducted through the more discreet channels of institutional investor communication, about the possibility of splitting HSBC into separate Western and Asian entities. The argument for the split, most forcefully made by Ping An Insurance, the Chinese insurer that became HSBC's largest single shareholder and that has publicly advocated for structural change, is essentially the argument that the combination of Western and Asian banking in a single institution is a value-destroying arrangement in an era of US-China tension, that the regulatory costs, the political risks, and the reputational complications of operating on both sides of the geopolitical divide outweigh the diversification benefits that the combination provides. The argument against the split, made by HSBC's management and by institutional investors who value the cross-border capabilities that the combined institution offers, is that the bank's ability to serve clients with operations across both the Western and Asian financial systems is a genuine competitive advantage that a split would destroy. A client that needs to move capital between London and Hong Kong, or between New York and Singapore, or between Europe and China, is better served by a single institution with relationships in all of these markets than by two separate institutions that would need to coordinate rather than operate as a unified whole. The debate is not merely theoretical. It reflects a genuine uncertainty about the future of the global financial system, about whether the US-China tension will produce a permanent bifurcation of the financial world into separate Western and Asian spheres, in which a bank that operates across both will face structural disadvantages, or whether the mutual commercial interests of the United States and China will eventually produce enough pragmatic accommodation to allow globally integrated financial institutions to continue operating effectively. The bank's management, under CEO Noel Quinn, and then under Georges El-Hedary, who succeeded him in 2204, has consistently resisted the split option while simultaneously pursuing a strategy of greater geographic focus, selling non-core operations in markets where the bank's competitive position is not strong, investing more heavily in the Asian markets where it has structural advantages, and attempting to demonstrate through operational performance that the combined model remains viable. The asset sales have been significant. HSBC has sold or wound down its retail banking operations in France, its US mass-market retail banking operations, its Canadian retail banking business, and various other operations in markets where its competitive position was not strong enough to justify the capital and management attention that maintaining them required. These disposals have simplified the institution's geographic footprint and concentrated its resources on the markets, primarily the UK, Hong Kong, and the broader Asian region, where it has genuine competitive strength. The China strategy continues to be the most consequential dimension of HSBC's forward planning. The Bank of Communications investment has been a more complicated asset than originally anticipated. The Chinese banking sector's performance in the years following the investment has been affected by the property sector crisis, the COVID-19 pandemic, and the broader challenges of the Chinese economy in the early 2020s. The specific value of the investment and the strategic rationale for maintaining it are questions that have become more pressing as the Chinese economic outlook has become more uncertain. The broader question of how HSBC positions itself relative to China as a bank that is genuinely committed to the Chinese market and willing to navigate the political complexities that commitment entails, or as a bank that maintains a significant China presence but is ultimately governed by Western regulatory standards and Western political values, is the question that will define the institution's character for the coming decade. Looking back across the full arc of HSBC's history, from the counting house on the Hong Kong waterfront in 1865 to the globally complex institution of 2004, what is most striking is the persistence of the fundamental tensions that the bank's founding context created. It was born in a world shaped by the opium trade and the specific commercial relationships that the Opium Wars had forced into existence. It served the British Empire as an instrument of imperial finance. It survived Japanese occupation and communist revolution. It navigated the handover of Hong Kong to China. It paid almost $2 billion in fines for money laundering and sanctions violations. It found itself caught between the United States and China in the Huawei affair. And through all of these experiences, it has remained, in some essential sense, the same institution, a bank that exists at the intersection of Western finance and Asian commerce, serving as the bridge between two worlds that have very different approaches to the relationship between markets and political power. The specific form that the tension between those two worlds takes has changed in every era of the bank's existence. In the 19th century, the tension was between the commercial logic of the opium trade and the moral objections to it. In the early 20th century, it was between the interests of the British Empire and the aspirations of Asian nationalism. In the Cold War era, it was between the commercial opportunities of the Chinese market and the sanctions and political pressures that Western governments imposed. In the post-handover era, it has been between the commercial and political requirements of operating in mainland China and the regulatory and political requirements of operating in the Western financial system. Each iteration of this tension has required the bank to make choices that satisfied neither side completely, choices that were always, to some degree, compromises between competing imperatives that could not be fully reconciled. The bank has made some of these choices well, and some poorly. The money laundering failures were, by any honest assessment, failures of management and culture that reflected poorly on the institution. The navigation of the handover and the post-handover China relationship has been, by most assessments, reasonably skillful given the genuine difficulty of the position. The Huawei affair has been handled with less grace than the institution's management would wish. What the full history of HSBC illuminates, more clearly perhaps than the history of any other financial institution, is the specific nature of the relationship between banking and geopolitics, the way in which financial institutions that operate across the boundaries of competing political systems are inevitably shaped by those boundaries, inevitably caught in the tensions between them, and inevitably required to make choices that no purely commercial logic can fully determine. Banks like HSBC are not simply commercial enterprises operating in a political environment. They are, in a very real sense, instruments of geopolitical competition, institutions whose decisions about where to operate, what to finance, and whose interests to serve are political decisions as well as commercial ones, whether the banks acknowledge this or not. The opium trade that shaped HSBC's founding context is, in this sense, not simply a historical embarrassment to be acknowledged and moved past. It is a paradigm case of the fundamental problem that the bank has been navigating in every era of its existence. The problem of operating at the intersection of commerce and power in ways that serve commercial interests without becoming complicit in the exercise of power, in ways that are, by the standards of the moment or of later generations, morally indefensible. The bank that was founded to finance the China trade in 1865 has become, 160 years later, one of the most significant financial institutions in the world. A bank whose decisions about where to operate and what to finance shape the commercial lives of tens of millions of people across dozens of countries. The weight of that significance and the responsibility it carries is not diminished by the scale of the institution's commercial success. If anything, it is amplified by it. The Hong Kong and Shanghai Banking Corporation that Thomas Sutherland organized in the counting houses of Hong Kong in 1864 could not have anticipated what it would eventually become. What it could have anticipated, what the specific context of its founding made clear from the beginning, was that a bank at the intersection of Asia and the West, in an era of enormous commercial opportunity and enormous political complexity, would face choices that no purely commercial calculus could resolve. That truth has not changed in 160 years. It is, in many ways, more true now than it has ever been. The world's bank. That is what HSBC calls itself in its marketing. It is a claim that encompasses both an aspiration and a history. The aspiration of an institution that genuinely serves clients across the full range of the global economy, and the history of an institution that came into existence in circumstances whose moral complexity has never fully resolved itself into the comfortable narrative that the world's bank would prefer to tell about itself. The story is not over. The bank is still navigating the intersection it has always occupied. The specific tensions of the present era between Chinese political assertiveness and Western democratic values, Between the commercial opportunities of the Chinese market and the regulatory requirements of the Western financial system are different in form from the tensions of previous eras, but continuous with them in kind. How HSBC navigates these tensions in the coming decades will determine whether the institution that survived the opium trade, 2 world wars, communist revolution, Japanese occupation, the handover of Hong Kong, and the largest money laundering fine in banking history can continue to occupy the specific and difficult position at the intersection of worlds that has defined it since that counting house on the waterfront in 1865. The answer is not yet written, but the history that informs it, the full, complicated, morally unresolved history of 160 years at the intersection of commerce and power in Asia, is available to anyone who is willing to look at it directly. This has been that history, and it is worth knowing. So we have traced the full arc, from the Hong Kong waterfront counting house of 1865, through the opium trade and the Opium Wars that made the bank's founding context, through 2 world wars and Japanese occupation, through the Communist Revolution and the Cold War, through the transformation into a global institution, through the acquisitions of Midland and Marine Midland, through the handover of Hong Kong and the China strategy, through the money laundering scandal and the Huawei crisis, to the strategically uncertain institution of 2024 that is still working out what kind of bank it wants to be. The HSBC story is, at its most fundamental level, a story about the relationship between financial institutions and the political environments in which they operate, about the way in which banks are shaped by the specific historical contexts of their founding, and about how those founding contexts persist in the institutional character, the commercial relationships, and the strategic choices of institutions long after the original context has changed. The bank was born in the opium trade. That is an uncomfortable fact, and it is one that HSBC's institutional history has not always engaged with the directness it deserves. The honest account is that the founding of the Hong Kong and Shanghai Banking Corporation was inseparable from the commercial world that the Opium Wars had created, that its founding shareholders were involved in the opium trade, that the banking services it provided in its early years were used to finance that trade alongside other commodities, and that the colony in which it was headquartered owed its existence to the wars that had been fought to protect the right to sell opium to China. The modern institution is not the opium bank that its founding context implies. It is a genuinely global financial institution that serves tens of millions of customers across dozens of countries, that employs hundreds of thousands of people, and that has, over 160 years, contributed enormously to the commercial development of Asia and to the financial systems that connect Asia to the rest of the world. The contribution is real. The complications are also real. Both deserve acknowledgement. The question that the HSBC story ultimately asks, the question that the history of 160 years at the intersection of commerce and power in Asia poses with particular clarity, is the question of what it means for a financial institution to be genuinely responsible in a world where the commercial opportunities and the political complexities are inseparable. It is a question that the bank has not always answered well. It is a question that remains genuinely open, and it is a question that matters far beyond the specific institution whose history has been the subject of this account. If this one expanded your understanding of how the global financial system actually works, and how the banks that structure it are shaped by histories that most of their current management would prefer not to discuss too directly, drop an A in the comments. These institutional histories are among the most research-intensive things I produce, and knowing that the depth is valued makes it worthwhile. The HSBC story is genuinely complex, and this account has necessarily simplified a number of dimensions. The specific mechanics of the opium trade financing, the detailed history of the Chinese government lending operations, the full story of the various Asian financial crises, and how the bank navigated them, the complete account of the money laundering investigation and its aftermath. If you want to go deeper, John Plender's writing on HSBC in the Financial Times and the Senate Permanent Subcommittee on Investigation's 2012 report on HSBC's compliance failures are both excellent primary sources. If you found this depth useful, subscribing is the simplest way to make sure you see the next one when it comes out. The natural follow-up to this video is our episode on Standard Chartered, the other great Hong Kong and Shanghai bank, HSBC's most direct historical parallel, and its most persistent competitor, whose own history of colonial finance, Asian commercial development, and compliance failures mirrors the HSBC story in ways that are instructive precisely because of the parallels and the differences. The link is in the description. Thank you for watching something that takes the full complexity of a great institution's history seriously. See you in the next one.